Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. I'd like to start off by thanking all of you that attended and participated in the Planet MicroCap Showcase Vancouver 2023, including our sponsors, speakers, presenting companies, and in-person attendees. With this being our first event in Vancouver, the turnout was absolutely incredible. We're truly thankful to each of you that took the time to join us in person or watched any of the keynotes or company presentations online. I'm currently working on getting all that content up on the Planet MicroCap YouTube channel. We will be back to Vancouver in 2024, but next up, Vegas. Save the date, Planet MicroCap Showcase Vegas at the Paris Hotel and Casino on April 30th through May 2nd, 2024. See you in Vegas. Now, my guest on the show today is Tobias Carlisle, founder and managing director of Acquirers Funds and co-host at Value After Hours. It's been well over a year since we've had Toby on the show, and I invited him back for his annual appearance. I feel like a broken record on the pod recently. We've talked a lot about how microcaps are in the doldrums. It's kind of putting it lightly. Redemptions plus no inflows, small micro strategies, can't raise new capital, etc. We haven't really talked about the quantitative reason, actually looking at the data for why the confluence of all these events are happening. Toby is the data king, and he does not disappoint in providing his perspective on what the data is telling us, including one semi-bold prediction about the big R word, recession. Thank you again for tuning in to the Planet MicroCap podcast, and please enjoy my conversation with Tobias Carlisle. Toby, thank you for joining me today. How you doing?
Hey, good to see you, Bobby. Thanks for having me back.
It's great to have you, man. I mean, look, we were catching up a little bit right before, and dude, it's been a minute. Like I can't. Obviously I can go and look at my archives and see when the last time we talked, but I'm going to be super lazy and say I don't remember the last time we chatted. But I think it might have been like well over a year.
That's probably right. I was head down for a long time with 2022 is nasty, but looks like we're back.
Well, that's why I wanted to invite you on today, because I mean, look, even though we're recording this on Wednesday, August 30th, this pod, if you're listening to this now, it's out on it should be out on Tuesday, September 13th or 12th. I don't know, one of those days. It's that week. You should be probably listening to this. So, I wanted to kind of start there actually, because I got an email yesterday from a buddy that when we published our last issue of the magazine, Planet MicroCap Review, we put that out last Wednesday on August 23rd. And since then, he had a stock in the magazine that he was following that's now kind of run up, not run up by any means. And, I'm not totally saying that it was the magazine's, that's the reason or anything like that. But long story short, he wrote me being like, dude, you published a magazine, you called the bottom. This is it. Small micro, it's coming back. And I don't know, I want to have some positivity here, just because literally every article we've talked about, I just published an interview with John Boyer talking about how, it's poor stock performance. There's no allocation to small micro strategies. So, I figured I'd have you on to see if you're seeing anything in the data to say, are we at a bottom now, or is things looking up? I don't know, but figured we start there.
I think I wrote an article for your magazine it's a few years ago now, two or 3 years probably. And I think it was something like it's a nuclear winter for value, which was true. That would have been pretty close to the bottom relatively to the market. That was about as wide, I think, as the spread got. And I think I said the returns from, that kind of value spread tended to be good or better as that spread closed. And the spread, it's been an incredibly long period of underperformance for value that started really, it depends on how you measure it, but you can, 2012, 2010, depending on what kind of tilt you've got in there, which metric you prefer, whether you sort of lean on book value or the flows, or whether you are more value as a philosophy rather than value as as sort of more of an academic factor, the way that the quants think about it, depending on how you actually measure it. And you muddy your own returns a little bit by including or excluding some factors and other things. But let's just say it's been a very long period of underperformance for value. And it's been one of the longer periods of outperformance for the other side of it's really been, the last decade was really characterized by large growth, and the other side of that spectrum, which is small value, really got left behind. And possibly the reason for that was that the cycle before that was very much small value, and probably it got ahead of itself, and the spread was very narrow by about 2015. I wrote an article saying that it was the worst opportunity set for value in 25 years in 2015, which had historically meant that there were poor returns going forward, and those poor returns did end up happening. It was much, much worse than I anticipated, but it wasn't. It was pretty unpleasant. And I think that somewhere around COVID, somewhere post-COVID, really in that between March 2020, which was the end of Q1, and say September 2020, which was mid to end of Q3, value sort of hit the bottom and turned around a little bit the way that I measure it. And so I think that since that period of time, value has outperformed, although it's been kind of bumpy. It hasn't been a straight line. It's been outperforming by a little bit. Well, first of all, it took a long time to get started after the COVID bottom was out of the bottom was very much like the stay-at-home stocks. It was all the Zoom, which we're on now, and all of those sort of newer .com type stocks, social, whatever characterized it. And they outperformed for a long time. Then value sort of got its feet, and value has run a little bit. Then, of course, we ran into 2022 when just everything sucked, and that persisted through some of this year. Although I think that the market itself, let's say S&P 500, has turned around, and it's now 5 or 6% below its all-time high. I think it probably, I don't know. I have no idea whether it gets back to its all-time high or not, which was end of 2021. So we're now 20 months beyond that. I think that value has tended to work very well out of a bottom, and it tends to do fairly badly towards the end of the cycle, because when people lose that fear, it becomes more greed than fear. The stuff that's been going up tends to be the stuff that gets bought the hardest, which is the large and growth, and small value almost definitionally gets left behind. So we're in a weird place where I think the value spread now has come into about what it is on average. The yields in those value portfolios, when you look at them on an absolute basis, are about average valuations. So that still means that I still think you get a little value premium. I think value itself as a philosophy is evergreen. The idea of buying something cheaper than what it's worth, to me, that just that makes sense to you or not, but it makes sense to me that that's the way I think of them. Like, I don't care so much about what the stock price does. I'm sort of looking at the underlying fundamentals of the business. And if you own stuff that's cheap and it's working pretty well and throwing off cash flows, you're going to do okay. You're going to outperform. And so those portfolios, even at average valuation, you would expect that there should be some premium over the market return. And I would think that there'd be still pretty substantial premium from here. So what I think that has been missed a little bit, though, in all of that is that really small didn't catch a break. If anything, it was like big value did okay. Mid cap value has done okay. Small value really hasn't done much of anything. So if there's any sort of premium left to be mined, I think that it's really in small value right now. And my portfolios, so I've got two funds. I've got a mid cap, large cap, which is ZIG, and that's domestic US. That I can look at the portfolio, the market capitalization that portfolio is pushing as close to its lowest it's ever been. It's really a mid cap, small cap fund at the moment. And I've got a small and micro fund, which is deep. And that's really, if you pull that portfolio up on Morningstar and you have a look at they do this little circle where they show you where the bulk of the holdings are. Like, it sits well below this Russell 2000. It sits below the, whatever the other small and micro type indexes there are out there. Deep sits well below both of those. So deep is holding, basically the only limitation on deep for how small it can go is the listing rules for ETFs. So that's like I don't think it can go below $80 million in market cap. And then there's also some liquidity constraints on it as well. But basically the stuff that it's holding is incredibly small and incredibly cheap. And when I look at that portfolio, like the PE on that portfolio, which is a reasonable representation of what the earning power of these portfolios is, like this is on an average basis, it's between 7 and 8. It's incredibly cheap. All of that stuff in there is very, very cheap. The question is, how does it perform when we go through, I don't know the reasons why, but let's say there's probably some, there's fears of a recession, at least. Let's say that there's recession fears, and how do small and micro companies go through a really tough recession, and they tend to be impacted quite a lot because they have less access to capital markets. The businesses are, they're single product companies. Often management's just less experienced, and so they can suffer a little bit more through that. But I think that they've already sold off, and so whatever happens, they're really, really beaten up at the moment. And I think the future looks pretty good for the very smallest stuff and the very deepest value stuff. So I'm very positive about the future, even though the last decade has been ugly for value and continues to be so. Even though we've had that I think the worst of the worst was the middle of COVID, but it's sort of getting close to being back to those depths now. Even though it had a little run, but it's come back down, relative and absolute. So I feel good, but the returns profile is not good.
Yeah, well, I mean, I think you hit on the main point that I think everybody that's been on this podcast of late and just talking anecdotally, especially when you're looking at allocations towards, micro managers, small micro strategies, and just seeing some of the performance. It's like, look, if they're the individual stock pickers, for the most part, are doing fine. And they usually do, because they know what they're doing. They know where the quality businesses are. They're finding opportunity. They're finding all sorts of inefficiencies because the opportunity set is really massive right now, like especially in microcap. But at the same time, when you're looking at, going more upstream, the folks that do tend to participate, in, probably mid to later cycle in like kind of microcap rallies, there's just a general fear of like, I mean, you guys put out an article, or Johnny Hopkins from your crew put out that article from Jeremy Grantham about, I think, what was that, on August 21st, about recession coming and running deep into next year. And everybody and their mother that follows small and micro know, you go in recession, like those are the first that get killed. And it's already been a 2-year bloodbath. Like, so what are we supposed to do with that?
And it wasn't great before then either.
No.
So it's been this is the challenge of being a small and micro investor, that you really, to be a small and micro investor, I think, obviously there are lots of different ways of doing it, but for me to get comfortable doing it, I'm looking at the fundamentals of these businesses. If there's anywhere where it pays to be a fundamental investor, it is in small and micro, because there is a lot of garbage in small and micro. And so I'm saying that if you go through and you find stuff that's cash flowing, well, let's start like stuff that's actually got a business, something that's got some recurring revenues at the or revenues at least. That's, if you cut everything out that doesn't have revenue, then that universe of stuff starts looking like a pretty healthy universe. And you look for the ones that are better businesses in there. And then out of, say, I don't know how many there are in there, but a few thousand, maybe more than 2,000 of that, a portfolio of like, there might be 300 or 400 that I think are pretty good businesses that are actually, making money. they might be challenged in the fact that they can't grow beyond where they are. They might just be businesses that they just tend to have to pay out a lot of their cash flows because there's not, even though people tend to be in small and micro for the growth, some of these businesses just, they can't grow, but they've got a little niche where they dominate in a little niche and they make plenty of money in that little niche, but they're too small for institutional size money. And it's an institution, I guess, because it's an ETF, but it's a very small ETF and it's an unusual kind of ETF in the sense that it does buy really, really small stuff. I'm not so interested in like getting a great deal of money into this thing as I am as just trying to generate pretty good returns, which I think you can do by being selective and buying higher quality stuff. And of the higher quality cheap stuff in there, I think that it looks as cheap as I have ever seen it really in that area. And the businesses that we hold tend to be pretty good businesses that for the most part do throw off cash, do buy back stock when they can. The businesses seem to me to be pretty robust with pretty good cash flow. So I think that, if we ever actually get a big crash again, which is entirely possible, all bets are off. Like they say correlations go to 1, everything sells off, but then they bounce quickest in the stuff that is undeservedly sold off. And so this tends to be why it pays to be in stuff that does buy back stock or has indicated a propensity to do that in the past, because they take advantage of the fact that they're undervalued, buy back a whole lot of stock. Hopefully you got some insiders who are buying along beside you, and they run pretty well out of the bottom. I've been doing this for long enough that I remember the cycles where small value was, that was a hot strategy at one point, and it's entirely possible that becomes a hot strategy again in the future. But I think if you want to participate in those hot strategies, you got to buy them when they're ice cold. And that is where small value is right now. It really is. It's gone from nuclear winter. It's not quite nuclear winter, but it's still ice cold. And I think that's what sows the seeds for very good returns in the future, low prices and pretty good businesses. So I think that's where we are. And I think that you and I will circle back in 5 years' time, 10 years' time. Say, I remember that conversation we had where everything was terrible, and here we are. We're red hot.
Toby, I'll tell you, dude, I feel like I've been singing from the mountaintops to every lay investor out there. Like, you want to be in the game? Now's the time to get in the game. Like,
right.
not necessarily just buy indiscriminately or anything, but like, if you really want to call yourself like, I'm a small micro cap investor, I'm gonna do the work and due diligence. Like, all right, let's go. Like, now these are these times. Like, sorry, I'm not trying to sound all like,
I couldn't agree more. I think that's true.
I'm not trying to sound all preachery or anything, but like, it's the truth. Like, you want an opportunity, here you go. Like, you just got to do the work. I mean, it's a lot of work. I'm not trying to say it's like the simplest thing in the world, but that every investor I'm talking to, all they're saying is, hey, even if I don't have a ton of dry powder right now, that's fine, because I'm busier than all heck, because I'm doing a ton of due diligence, because all these companies that I've been following that maybe had some run-ups are all trading 50 to 60, some cases 70% from their 52-week highs, and they're kicking ass. Quality earnings. And it's just because everybody hates small micro.
One of the challenges for small micro has been that the returns that have come recently have tended to be in energy and around energy type stocks, which a lot of investors these days everybody's been burned by the commodity super. Remember that the first 10 years of the decade of the millennium were this like commodity super cycle. China's developing, China's consuming all of these commodities. Anything that sells commodities has done really well through that period of time. And then that all ended, whenever it was, at the end of the 2010 to 2015, somewhere in there.
Yeah, the China, like all there was all the issues with the China accounting and everything. I think, what was that? That busted, what, 2011? I think
the reverse takeovers and all that sort of stuff.
Yeah, Maj, our boy Maj was on it.
That's right.
Maj was on it. Anyways,
that's good. Cool. It was really hard to tell. Like I remember that period very well, because of course that stuff screens really cheaply. Like I was when I started out as an investor, so I had been an attorney doing mergers and acquisitions and private equity and some small cap stuff in Australia and the US, in San Francisco, tech type stuff. And I had this idea because I saw in the early 2000s when everything got sold off, all of the nets, the net current asset value, stop liquidation value stuff came, where there hadn't been any for a long time. All of a sudden there were lots and lots of them. And I said, the next time that happens, I'm going to go and start doing this professionally. And then that happened in 2008, near the end of 2008, when the sell-off got really nasty. There were lots and lots of them around, and I went and bought a lot of them. And that was a good time to get started in small and micro, because they all did fairly well out of the bottom there. So I think that's often a pretty good indication of where you are in the cycle, is just how many nets are around. They're pretty easy to screen for these days, and you probably don't find as many of them as there used to be. But the returns, to be fair, the returns to them have tended to still be very good, and it really is a sub-institutional scale strategy. So it's unlikely that it's really ever arbed away by professional money, because anybody who does it graduates out of it. But I think that really what it says is that if something is trading at a sub-liquidation value, that's the market saying it's worth more dead than alive, you're really not paying for the business at all. You're just paying for the liquid assets on the balance sheet and backing out all the liabilities. So that really is very, very cheap. And they're all terrible businesses, and they're all kind of burning up the liquidation value, it's a little bit of a race against time, whether you get paid out or you get a bump in the stock before they dwindle to nothing. That's the theory. But when they're around, it indicates a lot of cheapness. And so that's the time when you should be doing all of the work, is when all of these things are battered down and really, really cheap. And I think we're kind of in that scenario again now, where everything is battered down. Everything is really, really cheap. Of course, when you look back, the returns are terrible, which is why particularly lay investors, but many people, professional investors too, they say, I'm not going to touch cyclicals because I've been burned so badly in cyclicals. I'm not going to touch small because I've been, you get in, you can't get out, and they don't perform. Not going to touch value because that sucks. So cyclical small value seems to me like a pretty good place to be at the moment, even though the track record is terrible, because when I look at the opportunity set looks pretty good. So that's where, for the most part, that's where I have been making my bets. I'm not like seeking those out. I take what the market gives. I take whatever is cheap and reasonable, and hoping that there's going to be a little acceleration in the underlying business, and then the valuation tends to follow the acceleration in the business. It's one of the counterintuitive things about investing, that to find the acceleration, you often have to be, you look backwards and you see falling prices and falling profits and losses and those sort of things. And if you look closely, you often see there are firms exiting the industry. There's a lot of distress, and that's a very good time to buy. And so the setup for small value is pretty good. The only sort of wrinkle to that is if broader macro issues sort of take over. But the broader macro issues tend to be pretty short-lived, even though it's 3 to 6 months, but it feels like a decade of sheer terror. But it really is only 1 or 2 or 3 quarters of the pain. And this is the time when it tends to happen too, when you're 18 months into a drawdown, haven't seen an all-time high for 20 months, and all of the sort of all of the hot money has kind of disappeared, and they're just waiting for a little trapdoor to open up. The funny thing is that there's, as you I'm sure you find the same thing. There's I don't know a single serious person who doesn't think we're going to go into a recession.
No, I literally. I mean, people are trying not to say it. It's like one of
everybody says it,
but now
but you can't.
Yeah. Like it's one of, it's like a forbidden, but like at the end of the day, like, yeah, literally everybody I'm talking to, like that is a legit real fear. And I think it's very warranted. I'm not going to even try and make a prediction on when, how long, all that stuff. Like I'm not nearly smart enough to even go down that road. But
I'll give you a prediction.
Oh yeah, give it, please. Yeah. Oh, you're gonna give me dude. I feel like I'm on Value After Hours myself right now. This is sick. All right, go.
So I get a little bit of shit for this, but I don't mind so much. The 10-3 inversion. So Cam Harvey is the academic who uncovered this thing. Very simple idea. He looks at the term structure of the treasuries, and he says that the near-term treasuries tend to trade at you get less interest on the near-term treasuries versus the 10-year or the 30-year treasuries. And the reason is that the longer you hold it, the more risk you have of inflation, whatever else going on, volatility, just movements in the market, your money's tied up, opportunity costs, and so on. And so it tends to be in normal backwardation, which means that the 3 trades at a discount to the 10. When the Fed comes in to crank up interest rates because they perceive the economy is too hot, inflation is too high, employment is too low, whatever they're looking at, the stock market is too high, whatever the sort of housing is too expensive, whatever things that they're looking at, where their impact is most keenly felt is at the front end of the curve. They don't really have much control over the end of the curve. A lot. I'm not entirely sure, now they're buying MBS and so on, so they probably control the whole curve, but really the bulk of most of their control is at the front end of the curve. So they crank interest rates and the 3 starts trading inverts and starts trading at a premium to the 10. And every time that has happened, going back in the data that we have I forget where it goes back to, but I think there's 4 instances pre-1986. So I think it goes back to the 60s, something like that. And there have been 4 instances post-1986. And the significance of 1986 is when K.M. Harvey published his paper. Every single inversion has led to a recession and a stock market crash. We've got an inversion that occurred in October 25 last year. We remain inverted now, which means that the Fed is still stepping on the interest, trying to get the interest rates as high as they can, or they seem to be that its most rapid increase we've seen in the data, and we're close to or almost exactly where we were in 2006, right at the very peak of the interest rate raising cycle then. The average length of time from the point of inversion to the declaration of a recession is 12 months. So that would be October 25 this year, literally to the day. Not that I think it's going to be that precise, but October 25 would be an average of 12 months. The shortest it's been is 6 months, which would have been April, and that didn't happen, end of April. And the longest it's been is January, is sort of 15 months, which would be about January 25, so late January. So anytime through this period of time, we would see that inversion leading to the declaration of a recession and probably a stock market crash that comes along with it. Every single time that the Fed has raised rates, they've got to a point in the cycle where they've realized that they've probably raised them too much because they get that breakdown in the market, breakdown in recessionary indicators, and then they start cutting rates. And the lag seems to be about 2 years from the point that they raise rates to seeing the impact and the point where they cut rates and see the impact. So I suspect that if this follows the course of every other inversion historically, and it may not, who knows, but if it does, then you would expect to see something at the end of October, and it could drag on for a very long period of time. It could be 2 years because it's been such a very long it's been such a long period of time between when we inverted and when anything has happened. So the conversation that I tend to have with people is they say, yeah, the inversion happened, like that was last year and nothing's happened yet. And I say, but the average time is like 12 months, right? So you wouldn't expect necessarily to see anything now, although you would expect to start seeing something soonish, like in the next few months. So that's sort of what I'm watching for. I think that's the most likely date. And I think it could be quite protracted. We're also at, any stock market measure that you like to look at, it's very, very expensive. The index itself is very, very expensive. And it's highly concentrated in large growth in 7 names. Everybody knows what the names are. If you don't hold the names, you've underperformed. If you do, you've outperformed. Having said that, actually, we have slightly outperformed not holding those names because we've had some exposure to energy and some other things that have worked pretty well through that period. And we did pick up Meta as one of the names. Meta sold off, got quantitatively cheap. We bought it. It ran up. We rebalanced out last rebalance day, which was end of July, I think. So I think that you really want to be in stuff that. So what do you do if you're a long-only investor like I am? What should you do?
Took the words out of my mouth. There you go.
You should be careful of the index because the index looks to me like it's expensive. That AI run from NVIDIA. NVIDIA's had this crazy run, likely as a result of having used the word AI. Like the returns are pretty good, but the underlying, it's justified a little bit. The underlying looks really good. They have grown like incredible, $7 billion year on year in revenues to like 11, and it looks like it's going even higher than that again. But the same thing happened to Cisco in the early 2000s or the late 1990s when there was this rush to the internet. Cisco was providing the routers. They were selling all the stuff that people were using. they were selling the tools, the picks and the shovels in the gold rush. And I think that NVIDIA is selling the picks and the shovels in this gold rush. And that's why, even though it is reflected in the fundamentals, it's possible that it's all of these other firms that are scrambling to sort of buy the chips so they can compete. And it's possible that they've just pulled forward a whole lot of sales from future years. And you might see a stumble there, which might be the trigger for the rest of the market to follow suit. I don't know, it could be anything. But I think, the answer is be careful of the index, but look at the places that haven't participated, which is small cyclical value.
So another question, by the way, great take.
That's my
why would you get killed for that? And listen, I apologize for people probably could call me dumb for even asking this question, but that's fine. I would get called dumb all the time. But why would people get mad at you for that take? You're just looking at the data, you're just seeing what historically has happened, and making I'd say relatively conservative prediction.
I think most brokers, the challenge for most brokers is that, or wealth managers or whatever the case may be, is having people remain invested in their strategies. And so they don't like the bearish guys who say, here, we're going to go through a period of, I would say that the way that I invest is I'm fully invested all the time, and I take incremental, because I'm youngish. I'm middle-aged, I guess, but I'm young at heart.
You're not that much older than me.
I've got a long investment horizon in front of me, is the way that I think about it. And I figure I've got 7 to 10 more bull markets and 7 to 10 more bear markets in me. So this next one coming, whether it's a bull or a bear, it really doesn't make any difference to me whatsoever. I'm just telling you what I think is going to happen. It doesn't really impact the way that I invest much, because I tend to be quantitative and I tend to be down in the cheapest stuff anyway. And so I'll be buying the cheapest stuff when the market's expensive. I'll be buying the cheapest stuff when the market's cheap. It doesn't really make much difference to me whatsoever. But I think I'm not going to tell people that it's all fine, and I think it's clear sailing ahead, and you should just stay invested all the time, because that's not what I think. I think that there's something coming, and I think it's going to be worse than usual. I think it's a 2000, it's a 2009, it's a 2023, 24, something like that.
So another question that I have regarding this, because I think, aside from some of those predictions, and looking at, some of the catalysts, maybe for acceleration in folks looking at, small micro, whether it's value growth, just in general, looking at small micro is, people like to see kind of just studs, right? They want to see some, an expel. No, I'm not a shareholder. They want to see more of that. And there really hasn't been kind of just a knockout, really great one in a while, and sometimes that's just from, organic growth, like an expel, like, just continuing to outperforming, just running the business efficiently, growing, all that kind of stuff. But then there's also just been, they're also looking potentially for special sits where there's maybe some potential takeout targets and getting nice premiums on that. And, then people starting to say, oh, that's interesting. Like this one got taken out for this. Maybe there's some others that are in that pool, but when you look back at the data that you're seeing right now, and comparing it to the last time you saw the data similar to right now, I think you said it was like around 2006. What were some of the activity in M&A? Was it also still relative? Because it's quiet. You're not seeing much of late. You're seeing little mergers here and there, but nothing, no big takeouts, no big, big splashy, wins from any of these microcaps that have been around for a while.
Yeah. I wonder if something structurally changed with Sarbanes-Oxley, but it's been a long time now. So Sarbanes-Oxley, I think, was like early 2000s.
Mm-hmm. Yep.
And basically it put another $1 million of compliance costs into firms to become compliant with Sarbanes-Oxley. And so, for a lot of small firms, $1 million is a material amount of bottom line, and it really affects when you can go public. And so the result was that I think VC carried their winners through small and micro, and they waited until they were big enough to get onto an index, because they had the money there. They could do it. They didn't need the returns early. Whereas what they used to do was flip them out into the small and micro index, and you could pick up, really good firms there that were going to grow through that index and grow out. And now, is that what happened? I don't know. And I don't know if that's a secular change or if that's just a cyclical thing that because we've had such a period of like success for those sort of businesses that it's just, that's what happens. It's a fashion and it changes. And I don't really know the answer to that. The thing that I would say is that when I was an attorney, when I was working, and I used to do some IPOs, I used to do lots of different things. But one of the articles that caught my eye was written by a firm, Piper Jaffray. It was called Darwin's Darlings. And the thesis was almost exactly the same that we've been discussing now. They said there are all of these great businesses that are just too small to get into an index. And even if they can get into an index, it's like the Russell 2000 that they get into, which there's no money in the Russell 2000. No one's allocating to the Russell 2000. No one's allocating to the Russell 2000 value. I can tell you that. So these businesses are like, they're growing 30% a year. They're trading at 5 times EBIT EV. They've got plenty of good cash flow. The founding family, with the founders still there, still running them, they've got plenty of runway. They've got lots of opportunities for M&A, but there's nothing happening in this sector. And they called them Darwin's Darlings because they thought they would be the target for private equity. And then we went into this, that was sort of the late 1990s, early 2000s. And then we went into this golden age of private equity, because that's where private equity really private equity is basically small value with some leverage on top of it. So they're targeting the very smallest firms. You know, the private equity deals that get the headlines are the bigger ones, but that's not really where private equity operates. It tends to be very much a small value strategy. So I don't really know why we haven't seen a lot of action there, other than the fact that all of the money has gone into VC and it's all in big VC. And maybe private equity just trades firms between themselves and they don't look on. That's crazy. Like I'm sure they'd be buying stuff off the public markets if they could find them, but maybe the takeout premiums just aren't enticing enough for people who've been struggling in these things for a long time. Having said that, you know, I've seen plenty of firms that the kind of stuff that I want to buy does tend to get taken out, although the prices are so low that like there's nothing particularly exciting in the bids that I have seen. I think they're stealing some of these companies, honestly. Yeah. A few that I really liked got taken down by private equity or management. And I thought they were really great businesses. That there were a few that were the value managers who were publicly listed, who I don't want to say who it was, but you know, they had like $50 billion in assets. Market capitalization was 600 billion, mostly owned by the insiders, paying out close to 100% of earnings because, you know, there's really no reinvestment opportunity in an investment firm. And they all got taken out at prices that were very, very low. And I was a little disappointed with some of them. But I think that, I think that we probably just need a little bit more. A little uptick in that cycle might bring all of that back again. But I do think that the fact that article, Darwin's Darlings, which came out in 1999, and then there was a follow-up in 2001, which was a similar kind of name. It just escapes me at the moment. But that really was the precursor to all of the private equity and activist action that happened in the early 2000s. So I suspect the next cycle we see a lot of that private equity and activist action, particularly in small value cyclical stuff, probably.
If we go into a recession, I think we're going to see a lot of M&A pick up, and it's all because you gaming it out a little bit. You think, okay, some of these larger firms are probably thinking themselves, all right, every economist, every Toby out there is out there saying we're going to be going into recession sometime between now and January. All right, that usually means that small micro gets continued to be taken out to the cleaners. And, you know, then we can start looking at making some bids on the ones that we like, you know, and just try and pick them up cheap. I mean,
the other thing about private equity, though, like they're often thinking about their sales strategy as much as their purchasing strategy. So they're trying to look at, like, if we buy this thing, can we turn around and sell it back onto the public markets? Like, probably not. Right. The public markets, there's not a lot of IPO activity. And where there is IPO activity, it's large growth stories that don't necessarily have to have a lot of earnings or business or cash flow or anything like that. Whereas these things are, you know, they're kind of more financial type, you know, it's a financial thesis where it's not a growth thesis. It's not going to be making money in the future. It's making lots of money now. It's buying back stock. We can take it private, play with the capital structure, maybe merge two of these things together, then flip it again. But there's, you know, the flipping it again is or listing it onto the market is their best outcome. Maybe there's just not. market there for these things.
Yeah, but I mean, they probably have a little bit more of a long-term horizon. Like, let's say they buy it up. Let's say they could probably afford, especially if that firm they're looking at, the smaller ones are throwing off cash. Like, all right, we'll wait 2 years. Okay, so let's say January is your main starting point for said recession. They're buying up businesses that throw off cash, and they're waiting 2 years out for maybe things to start coming out of it. Things start heating up again. Hey, like I said, they're buying firms that are throwing off cash. They can kind of start to merge a couple things, maybe buy a couple other things, and then 2 years down the road, flip it. I don't know.
I like that idea. I think they probably think, well, if we're going to go into this soft period, we'll get these things cheaper, and then we'll hold them through that cheap period and flip them again. I don't know, but I find it a little bit perplexing too. I think that there's enough stuff around it. Maybe you've got to negotiate with a owner operator who, they're going to want a pretty good premium, and they're probably going to want a pretty good slice of equity too. And maybe it just doesn't make sense financially, can't get there.
Yeah, no, it's an interesting time period. I mean, we'll see. We'll just keep seeing.
I think the real answer is that there's a lot of weakness out there that's not captured in the headlines. I do think there's a lot of fundamental weakness out there. And so you need to be very, very careful as you're going through these things. We tend to normalize for the most part. So we're trying to buy things that wherever they are in any given year is kind of irrelevant. We're looking at the full cycle in a valuation sense, trying to buy stuff that's cheap, trying to buy stuff that has the potential to over earn through a 3 to 5 year period, which is the acceleration often out of a cyclical trough. So they look really nasty when you buy them, but they do get a little bit better after the holding period. It's just that I don't know what it is. Maybe they're too small or something, but I think that the weakness in the underlying economy continues to be a real thing. And that's probably the real reason why there's not a lot of action.
100%. I mean, you also have to, not to go too macro, not necessarily conspiracy, but I mean, look, we got an election coming up next year.
Right.
People want to stay in power. You can imagine on the Democrat side, they want to suppress those weak economy headlines as much as possible, because there you go. If that starts really gaining traction, there you go. You're just you're handing the election to whoever is the Republican nominee at that point.
Right. And there's a lot of fiscal stimulus out there at the moment too. The Inflation Reduction Act, the federal government's running huge deficits. All of that is stimulative. It's stimulating into a very weak economy, I think. So that's why, inflation seems to have come down after, there was some fundamental reasons for the inflation, just the fact that there were shortages and gluts and all of these weird things going on. So it's really hard to tease out exactly what's happening, but there's some real inflation out there. And even though we're talking about inflation sort of slowing, the genie isn't put back in the bottle by any sense of, the inflation that we've seen hasn't reversed course. It's just slowed down, and everybody's still got that sticker shock where, I can see in my Mint account, which is tracks the family spending. Like, the family spending is up a lot, and it's not like our quality of life has improved. It's just, we're just spending more money. I said to my wife, it looks like we picked up a fourth kid on the way through there, the spending's up so much.
So true, dude. I mean, you took the words out of my mouth again. Just anecdotally, from going to the grocery store, going to the pump. I mean, inflation sounds like, oh, really? Oh, okay.
The rate of change is down, but inflation's not down. The inflation is sticky. It's here to stay, and it's across everything, right? It's in housing, it's in gas prices, it's in groceries. It's across everything, and that does suck out some of the purchasing power. The funny thing is, the one sector that's kind of been unimpacted by it seems to be luxury. And it's one of the weird things. If you have a look at what luxury did through 2008, 2009, so Coach got really, Coach, they make the bags. It was popular at the time. It was like a successful thing at the time. I bought it at the time. I bought it in 2008 because it got really beaten up, but the revenues were pretty solid through that. People didn't stop buying that stuff, even though there was a pretty nasty recession. That was the real thing.
You can think about it from a consumer perspective. It's like, all right, I'm already paying, just for consumer staples, I'm paying this, and this is something I really want. And it's all right. I'm expected to have to pay that much. Right. And if you just really want it, you're going to do it. So so that's an interesting take. I
And
hadn't
people
thought
like
about it.
small luxuries. People do tend to buy small luxuries through periods like that. So
Right.
luxury's held up really well, which I find kind of it's perplexing, or maybe it's a little bit sick. It's like the top end of town's doing very well, and everybody else is struggling. No Coach bags in my house.
Yeah, someday I'll get that Goyard bag that I know that my wife really wants. You asked me about Coach. I know the bag. I know a little thing or two about some of these luxury bags now, but we covered a lot. We're almost there. I mean, I'm sure we could go on for a lot longer. So, I mean, you want to give us your final take? I mean, you're kind of given us already so much in terms of your expectations and prediction. But, let's say an investor's listening to this and thinking that I got to go to the mattresses. Like, okay, like you don't need to go to the mattresses, but how, as a lay investor, what should you be doing right now? Especially if they're not going to have the time or the energy to go in and make individual, stock picks or anything like that.
Well, you should know about me that my default setting is pretty bearish. I'm always like bearish over the next 3 to 5 years, but beyond that, super bullish on civilization and humanity. So that's why I think that, which is a good setting, I think, for a value guy. You want to be making sure that everything's going to survive in the near term. And then beyond that, the upside kind of takes care of itself. You're buying free optionality on the upside. And so in some sense, dark clouds on the horizon are a good thing because it creates those opportunities. The only thing is when I look around at the moment, I don't see a lot of risk-adjusted opportunity for the most part through most of the market. I do think that where there are pockets of risk-adjusted opportunity, they are in places where nobody wants to go because it's small, it's value, it's cyclical. And that tends to do very badly through a recession and a depression. And it has done very bad over the last decade. And so people, looking at that will say, this seems like a terrible idea. But I think that if you can pull back a little bit and you look at the very long-term historical returns to small value, cyclical particularly, they are pretty good. And that probably the near-term underperformance means that there's some near-term outperformance coming too. And if your time frame is 5 to 10 years, which I think it really should be for stock market money, because nobody knows what can happen in the interim, then this is a pretty good time. And if you start now and it does get weaker, then that's a good thing. It means that, because I think that the weakness is sort of imminent and it should be over equally pretty quickly. So you go into a really nasty period, this is what's going to happen for everybody. You get invested and then the weakness hits. Like that's just it's unavoidable. It's just it's an iron law of the market that it's max pain for everybody all the time. So whatever you do is going to be wrong. So don't worry about that in the short term. You just have to be patient and have a longer term horizon and put money away and just think, I'm not investing one wad now. I'm going to be earning for the next 5 years as well. So I should invest through that period of time, and you get better prices if the market goes down, which would be a good thing because lower prices mean higher returns in the future. So I think that the US is still a great place to be invested. I think it's probably the best place in the world to be invested from a rule of law and from a sort of attitude to risk, attitude to investment. The rest of the world hasn't produced things like Google and Microsoft and those big consumer discretionary, consumer staples type businesses. The US is sort of unique in production of those things, and there will be others that come out even though they don't exist now. I don't know where they'll be, but this is a good place to be. It's good to be in the market for the most part. Your default setting shouldn't be zero invested in the market. It should be, Graham said no less than 25%. I think it's probably higher than that. It should be, depending on where you are. You should consult a financial planner or wealth manager or whatever to talk about what your default setting should be. But I think that from my perspective as a small value guy, this is a good time. It's a good place to be. And I think that the next decade will probably likely be small value cyclical just because the last decade's been so bad and values are so crushed.
Well, I think that's a great place to end it. And, look, if anything, apocalyptic happens between now and when this interview comes out, I guess I'll have to bring you on real quick to do an addendum in some. But before I let you go, a few names that were mentioned that wasn't clear on disclosure: Zoom, NVIDIA, Google, Microsoft. Just Quick
I don't hold
disclosure.
any of them. Yeah, I don't hold any of the big stuff. The only stuff I hold my funds, Zig and Deep, and
Gotcha.
whatever's in those funds. I guess I hold by, but I haven't talked about any of those through this year. I don't hold any of the big stuff. I don't hold any of the Magnificent Seven.
Very good. All right. Well, Toby, with that, where can people go and subscribe to your newsletter, learn more about the funds, and of course, subscribe to the Value After Hours podcast?
So I have acquirersmultiple.com, has all of the books, has a free screener, has links to the podcast, and Johnny Hopkins posts great articles on that all the time. And the funds are Zig and Deep, and you can either just Google those tickers or go through the acquirersfunds.com to find out more.
Very good. Well, Toby, always a pleasure speaking with you. Thank you so much for joining me today. Good luck. Stay safe. I look forward to our next update.
My pleasure. Thanks for having me on, Bobby. It's always fun.
Thanks, man. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.